Yes, very clear. You can see the screen.
All right. Okay, good. So good morning once again. My name is Francis Kofi Oduro, and I'll be taking you through the topic, the stock exchange and the economy. Now, I'd like for everyone to keep an open mind. This is a quite interesting topic, and you need to have an open mind. If you haven't sat in an economics class or a finance class, I'd entreat you to keep an open mind and enjoy this session. So the stock exchange hereinafter will be the stock market, okay? So the topic, once again, the stock exchange and the economy. Now, the stock market. So we hear the stock market being bandied about a lot. We hear it everywhere. We hear it in the news. We hear it on TV. We hear it on the streets. We hear financial experts and investment analysts bandied the term about a lot. Now, you ask yourself, what exactly is the stock market, right? Now, I like to look at it in a more simple term, okay? Just so that you will be able to relate to what the term actually is. And if you look on the screen, you would see on your left side, you have our popular molecular market. And on the right side, you have the exchange. Okay, so in describing what the stock market is, I decided to look at what actually is being done when you go to molecular market, okay? Now, if you look at molecular market, you have buyers and sellers meeting at the market to transact business, right? So you go to molecular market, let's say you go to buy tomatoes, you go to buy onions, any kind of foodstuff you can imagine. Now, once you get there, you have a number of sellers, okay, ready to sell. Now you interact with whatever or whichever seller that you meet, right? And at the end of it, you sort of transact business in terms of what you are buying and the money that you part with. Okay, so molecular market is a place where you have buyers and sellers of goods and services. Now, if you come to our stock market, it's about the same, okay? It's also a market where you have buyers and sellers of securities or financial instruments, right? Now, if you look at the picture again, you will notice something about the two pictures. You notice that one is more organized than the other, right? The one on your right, which is the stock exchange, is more organized than the one on your left. Clearly, you can tell in describing the stock market, it is an organized market where you have buyers and sellers of securities, okay? So you liken stock market to normal markets in Accra, but the difference here is that the financial instruments being bought and sold, okay, just like our tomatoes and onions being bought and sold in molecular market, the difference here is that one is more organized than the other. And the stock exchange is an organized market, okay, where you have buyers and sellers of securities. I hope that makes sense, please.
Yeah, it does.
Yes, it does.
All right. So clearly, you can tell that this is where you sort of have buyers and sellers of securities. I mean, when we say securities, you know what we are talking about. These are financial instruments like shares and bonds, okay? And we are also saying that the stock market, just like our local market, you have buyers and sellers who meet to transact business. And what business are we talking about here? it is the purchase and sale of bonds, shares, any financial instrument that you can think of. Okay, so next, we move on to our next slide. Now, we've just touched on what the stock market is. And so we know that the stock market is an organized market where buyers and sellers meet to transact financial business, to purchase shares, to purchase bonds, to sell bonds, to sell shares, right? Now, this is the economy. So let's take a look at the economy in a simplistic manner. I mean, it's quite simple, okay? A lot of times we hear the economy this, the economy that. It is not rocket science, it's quite simple. Now, I decided to put it in this format just so that you can understand what exactly goes on in an economy, okay? On your left side, where we have the producers of goods, i.e. production, right? Now, the people that make things or produce these goods, in the picture there you see tomatoes, so production of tomatoes. Now, the people that make these goods or these tomatoes, once it's produced, they have to pass them on to people that want it, and that's consumers, right? So you don't produce goods and leave it on your shelf, else it's going to rot. You don't produce tomatoes, you don't bake cake, you don't bake bread and just leave it on your shelf. You definitely will have to pass it on to a consumer, okay? Meaning consumers will buy these goods or these things that you're producing. And what do they buy with? They buy with money. So the money will go to producers, to the producers, right? So producers or sellers produce, they pass them on to consumers. Consumers pass on money to the producers. That's consumers pass on money to producers, and then producers will produce more and send them back to consumers, and consumers will send money back. So you have this kind of cycle. And that's what economy is all about. It's all about production, producing, passing it on to the consumer parting with money to the producer, and the producer producing more, being in a position to produce more, and then passing on. So it's a form of cycle. The producers will use the money to produce more and send it to people or consumers, okay, make more money and be able to produce more. It's quite simple if you look at it that way, okay? So there's a producer on your left, there's a consumer on your far right, and then you have the money in the middle, the exchange of money. And this happens with individuals. I mean, we transact, individuals produce, send them to people. This happens with companies, and this happens with countries. Now, if you look at the countries, that leads to imports and exports. So you have one country like America producing cars, having consumers here in Ghana buying those, importing those cars, paying money, okay? So that's what leads to imports and exports. Now, there's one last thing I would like to introduce to make us understand the economy better. So like we've said, with the economy, you're looking at producers on one end, you have the consumers on the other end, and you have consumers paying for these goods and services being produced by the producers, okay? Now, I'll introduce one last thing just so that you can understand what goes on in the economy better. And that's on the next slide. Yeah, so if you look at the previous slide, let me go back. If you look at the previous slide, you have your producers, you have your consumers, and you have money. Now, on the next slide, I have introduced government. Okay, now what does government do? Government passes laws, or government introduces laws, right? So the government can step in, and government steps in and make laws. Now, they step in, they make laws, and then they say that, okay, producers, you can produce this quantity of goods, you can produce so much, you can produce this amount of goods. Consumers, you can consume so much, you can't consume this, you can't consume that. That's why you have in some countries certain goods are being banned, okay? It's being banned because you have laws, you have government that comes in to set those laws. They can say, okay, you can produce these goods or services, and can also say you can't do this thing. Consumers, you can't consume these goods. Producers, you cannot produce these goods. There's some what we call checks and balances, right? Some countries may decide that we won't apply government laws, we won't apply laws. I mean, the economy is open. You can produce whatever you want to produce, you can sell whatever you want to sell, you can buy whatever you want to buy. And that kind of economy is what we call the free market or the free enterprise economy, right? And now most countries, and I say most countries do what you call practice this kind of have this kind of economy where they have the free market economy. So it's more relaxed, it's more liberal, okay? And then there are countries that control almost about everything, anything you can find in the country or in the economy. They control every single thing. They will say that produce this, they produce this amount of goods, they hand it over to consumers. They'll say, okay, so consumers, you can consume this volume of goods. You cannot go beyond this. One person to one particular good. You get it? You can. It's not liberal. It's not open. All right. And usually, such economies have like what we call a one-party state government. Okay, controlling all affairs. And I mean all affairs. So it's not open. You don't have a free economy. It's sort of rigid. It's tight. Usually they do that so that there can be equity. So they claim there can be equity in the country. Now, countries where, like I said before, almost every country now practices the free market economy, okay? But there are few countries that sort of have this rigid system where they are controlling everything. And usually you'd say you can say that would lend itself more to like a communism, okay? I believe you know what a communism is. So everything is being controlled. And like I said, usually a one-party state. And such countries, I think, would be China, if I'm right, Cuba, North Korea, and I think Vietnam. These are countries where the laws are strict and they control almost about anything in the economy. So yes, this is quite simple, trying to make you understand or make you know that the economy that you hear about, it's simple. This is the basic form of trying to get you to grasp or understand what actually goes on in the economy. And in real life, of course, it can be more complex, okay? So yes, it can be more complex, but this is a simplistic description of what the economy is all about. So you have producers, you have consumers exchanging, parting with money, producers getting more money, producing more, passing on to consumers. You have government making laws and all that. So that basically talks about what the economy is all about. So the next slide, we have a line graph here, and you can see this is the Ghana stock market versus the economy. So a little recap. We've talked about what the stock market is. We know it's an organized market where you have buyers and sellers of financial instruments or securities, bonds, shares, and any other financial instrument you can think of. We've looked at the economy. We know in simple terms, the economy is about producing goods and services for a certain group of people, consumers. Consumers pay for these goods. Producers get more money. They produce more, they pass it on. Government comes in, plays its role, sets some laws so that people do not go overboard. In some countries, there are strict laws where the volume of goods and services that are produced are marked. And in some economies, it's quite liberal, where you have the free market economy and all that. So at least we know what the stock market is, and we know what the economy is. Now, if you look at this graph, what I've done here is to compare the stock market to the economy, right? And you notice that the stock market, I've used the orange line, which is the Ghana Stock Exchange returns. Okay, I've used that as a proxy. You do understand what that means, right? As a proxy. So the stock market on this graph is being represented by the GSE returns, and that's the best proxy you can get. Now, if you look at the economy, I have used the GDP as a proxy, and also that's the best proxy that you can ever use when you want to look at the economy. So now let's look at the stock market. We've looked at the stock market on one end, we've looked at the economy. Now let's look at the stock market together with the economy and get to know how they affect each other and what the differences are. Now, the theory, I mean, if you know of the theory that says that the stock market is often seen as the gauge of the economy, right? So if you want to gauge this, there's a theory actually that the stock market is a gauge of the economy, meaning when stocks are up, it's seen as a positive signal, okay? And yeah, if stocks are up, it's seen as a positive signal and the growth in the economy at large. Over the long term, the two, that is the stock market and economy in terms of GDP, have broadly moved in line with one another, okay? So again, the theory, meaning when the economy goes in one direction, the stock market follows. If the economy goes into another direction, the stock market follows, okay? Now, because the stock market is seen to reflect the economy, it should make sense for the stock market to move in the economy's direction. I hope you're getting me. Can I go on?
Yes, sir, please go on.
All right. So because the stock market is seen to reflect the economy, like I said, it should make sense for the, the stock market to move in the economy's direction. And you will notice that that is more pronounced in advanced countries like America, in UK and other European countries, okay, where the stock market there is an actual and true, reflection of the economy. Meaning, when the economy goes up, the stock market would follow. And again, like I said, this is theory, okay? And it is so because in America or in Europe, the stock market actually reflects the economy, meaning you have a lot of companies in the economy that are on the stock market. Do you get it? So you have the, let's say in America, where you have the New York Stock Exchange, you have a lot of companies in the economy that finds itself on the New York Stock Exchange. Okay, so in that sense, it's like the stock market in America is reflecting the economy. Because once you have a lot of companies that in the economy in the US find itself on the stock market, obviously it's just mirroring, the stock market is mirroring the economy. Now in Ghana, it is not the case. In Ghana, currently the stock market has just about 41 to 43 companies listed on the market. And that is not a reflection of the economy, because the economy, of course, we have a lot of activities or companies here in this country, but you just have about 41 to 43 companies. So it is not really reflecting the economy. But now, given the actual figures, which you see on the screen, again, like I said, the stock market representing the GSE returns representing the stock market, the GDP growth representing the economy. Now, like I said, in theory, economy goes one direction, stock market should follow. So let's look at what we have here. Let's look at the line graph. In 2012, if you can pay attention, in 2012, you have the GDP growth rate of Ghana, right, at 9.3%. Now, this is a drop from 14% to 9.3%. In 2011, this is a 10-year period, by the way. In 2011, we had 14% GDP growth rate with a GSE return of negative 3.10. Right? In 2012, the GDP growth rate dropped to 9.3. But what happened to the Ghana Stock Exchange market? It shot up to 23.81% from the previous year of negative 3. Do you see what I'm saying? Now, the GDP growth dropped, but the stock market went up. Obviously, that has defied the theory of economy going one direction, stock market following. It has defied it. You see it. Now, in 2013, the GDP growth rate is 7.40, obviously gone down lower than the previous year. But what happens to the stock market returns? Up 78.1%. It has defied the theory again. In 2014, GDP growth rate drops to what? 2.90, and the stock market for once drops 5.40 from 78% the previous year. So now we can see the theory taking place here, that economy moves in one direction, the economy dropped to 2.9, we had a stock market drop. And you can follow through to 2020, where we had what do you call it? A dip in the GDP about 0. Let me try. Yeah. The 0.40 GDP growth rate. I mean, of course, we all know what happened in 2020. COVID is still around though. So our economy didn't really grow. We had 0.40%, and we had the stock market also dip into negative 13.98. So obviously, this follows the theory of stock market following the economy's direction. Okay, so let's look at the next slide. Okay, so this slide looks at trying to compare the US market, the stock market, to the US economy. Okay, so you have the Dow Jones Industrial Average. Now, I decided to use one of this particular index, which is the Dow Jones Industrial Average. The American stock market has got different, what do you call it, indices. They have the Dow Jones Industrial Average. They have the NASDAQ. Now, the NASDAQ is a market that reflects, or a market that has mostly technological firms, okay, listed on that market, like Apple, Facebook, Google, you know, any technological firm. And there's a S&P 500. The S&P 500 usually, well, not usually, the S&P 500 looks at the biggest 500 companies in America, okay? So the S&P 500 is also being represented by the top 500 companies in America being listed on it. And then the Dow, I decided to use the Dow Jones Industrial Average because this is widely watched. It's I can say it's quite bigger. It's widely watched as well by the news agencies and other economic analysts. So again, the Dow Jones Industrial Average has a proxy here, which representing the stock market, and then the economy's proxy also here is the GDP growth rate. Okay, so let's look at this one. In 2012, moving from 2011 to 2012, the US had a GDP growth rate of 2.25% in 2012, meaning from 2011, where it had 1.55, it went up to 2.25. And then what happened to the stock market? The stock market moved from 5.53% in 2011, and in 2012 returned 7.26. That's an increase. So you see the difference here. Previously, remember I said because in America or in any European country or in the West, the stock market is reflecting the economy proper. When the economy goes in one direction, you have the stock market following, okay? But it doesn't really mean that is always the case, okay? We have seen instances where there's a divergence, okay? Now, if you look at a graph, it is seriously sort of, I see a clear divergence here, like one market going one way, another market going the other way, okay? But in 2012, where you have the GDP growth rate 2.25 going up from 1.55, and the stock market in America represented the stock market in 2012 having 7.26 up from the 5.53 the previous year, you see that it's in the same direction. Economy went up, GDP went up, what do you call it? The stock market also went up. So this is not defying the theory. This is in line with the theory, okay? Now, in 2013, the GDP growth rate dropped to 1.84%. And what happened to the stock market? Poof, 26.50. This has defied the theory. Okay, so if you look at it, you see that the the return go that way, and then the GDP sort of dip. In 2014, you have the GDP growth rate go up. You have the stock market returns also drop. Again, define. So if you look at it all the way to 2020, you see instances where they are not in line. Okay, it's moving, it's sort of defying the theory. Okay, so clearly the theory that the economy and the stock market should move in the same direction is not really something that you know, you can say is a cast in stone or hard and fast rule. It's sort of in real life, the opposite do happen. And that's why you're having this sort of fundamental divergence, as we call it. Okay, so yes, slide. Okay. Now, we know countries have undergone the worst economic contraction. I mean, countries have really gone through hell, especially even this time from 2020, COVID hitting the world. We've seen some worst economic contraction over the years. Yet we saw stock market in some countries go up, okay? And in years where we had economic expansion also, we saw the stock market sort of dip. Maybe we should go back and see if we can see something like that. So yes, in 2020, look at the US. In 2020, the economy, we had a, what do you call it? Let's take 2018. Let's take 2018. Look at 2018 figures. From 2017 to 2018, the GDP growth rate in America was 3%. It went up from 2.33, yet which we can say which is an expansion, but we saw the what do you call it? The stock market dip, negative 5.63. All right. Okay. So clearly, this should tell you the truth is that the stock market and the economy, they don't actually measure the same thing. This is clear. I mean, the theory is on one side. As I said, the theory says it's has its claim, but with what we've seen, the truth is that the stock market and the economy, they don't actually measure the same thing. Yes, they are closely connected. No two ways about that. They are closely connected, but there are fundamental and substantial differences in what they actually represent, in what the stock market represents and what the economy also represents. And that brings me to this slide where we're going to look at the difference between the stock market and the economy. Okay, so we have the stock market on the left, and for me, I decided to, since we're in Ghana, I decided to put our indices to talk about our indices. Now, let me, for those of you a bit confused for me using the term indices and all that, it's a measure. In everything, you need to measure it. I mean, in finance and in economics, Everything is being measured. Okay, so in our stock market, we are measuring the stock market, and that's why you hear me talk of indices and index and all that. We are measuring the market. Okay, so we measure the economy, and if you've done economics or finance, you know that in measuring the economy, you use the GDP, gross domestic product, right? So in measuring the stock market in Ghana, we have what we call the Composite Index. All right, we have what we call the Composite Index. We have two indices. We have the Composite Index, and we have what we call the Financial Stock Index. Okay, the FSI and the CI. Right. In America, if you look at the previous slide, this is the Dow Jones Industrial Average. This is one of the this is an index. Okay, America has quite a number of them. They have the Dow Jones Industrial Average that focuses on blue chip stock companies. Blue chip. When you say blue chip, you're talking about the big companies, blue chip companies. We have the NASDAQ. I think I mentioned the NASDAQ. So the NASDAQ measures or looks at technological firms, Google, Apple, Facebook, these technological companies. And then they have the S&P 500. Okay, so the S&P 500 is looking at big companies as well, like the top 500 companies, being listed on the market. So these are indices, okay? And then you come to Ghana, we have the Composite Index, and then you have the FSI. So it's a market index. So that's why you have, if you look at the left side, we have the GSE, the Ghana Stock Exchange -CI, which is Composite Index, and GSE-FSI, which is the Financial Stock Index. And this is a market index, okay, which measures, measures the value of a section of the stock market. Okay, so you can have the the stock market measure a section of the market, and you can have it measure the entirety of the market. So the Composite Index looks at the general market, just so you know. Okay, it comprises of all listed companies in Ghana on the market, whilst the FS comprises of the measurement of the value of financial stocks. So if you talk about any bank that is listed on a stock like EcoBank, GCB, Cowbank, when you talk about its measurement, you can refer to the FSI. But one thing you should note is that because the Composite Index comprises of all the listed companies, you can pick the FSI from the Composite Index. So the FSI is sort of like a subset of the entire market. Okay, so for example, now every single day, as long as it's a working day, aside holidays and weekends, every single day, the Ghana Stock Exchange reports on the market. Every single day, they release what we call the official list, and the official list will give you every single activity or action that has gone down on the market. Okay, so when, let's say, the price of MTN, MTN Ghana is listed on the stock market. So if, let's say, the price of MTN goes up or down, okay, if it changes, it will affect just the Composite Index. Do you follow? If MTN changes, if MTN goes up or down, that affects the Composite Index and not the FSI and not the Financial Stock Index. But when a company like EcoBank goes up or down, it affects both the Composite Index and the FSI. Does that make sense?
Yes, it does. Kindly move on. I see you're finishing all your water. Move on.
All right. So the value of the market goes up when prices, the value of the stock market, be it the Composite Index or the FSI, goes up and down depending on which direction prices go. So market goes up when prices go up, market goes down when prices go down. Okay, now you should note that the stock market does not represent, I've said it already, that the stock market does not represent all goods and services in the economy. I stated that previously, that the stock market does not represent all goods and services in the economy. But when you come to the right side, which is the GDP, the economy, it represents every single thing or action that goes on in the economy. Quite clear. So we're looking at the differences. We've just touched on for the stock market, we've just touched on the Composite Index and the FSI. I've explained what the Composite Index does and what the FSI does. And I've explained what happens to this index when a particular company on the market goes in a certain direction, and what does not happen to the other. I've explained that. Now, on the right side, you're looking at the GDP, the gross domestic product. So the economy is a much broader measure. Okay, that's why I said it takes into consideration everything that goes on in the economy. It's a much broader measure. It takes the entirety of goods and services that a country produces. So economy, previously we talked about what actually goes on in the economy. You know, production is the main thing to consumers and all that. So GDP, that is what the GDP does. It takes into account what actually goes on. It doesn't take into account just the value of GDP does not take into account just the value of markets that are listed on the stock market, unlike the stock market. Okay, so for stock market, the index or the indices, its measurement is solely what is on its market. And there are about 41 to 43 companies listed on the stock market. So you can take all of them and do the kind of measurement. But the economy is broad, like it's really broad. Okay, I mean, it's measured, that's why we are looking at GDP. It's measured through the GDP, okay, which is equal to the value of all goods and services consumed, plus government spending, investments, imports and exports, net exports, you know, so that's what the GDP does. Another one we can, the next point is the scope. So because I said the stock market index looks at just the number of companies that are listed on the market, whilst the economy focuses on all goods and services in that economy. Clearly, you can come to the point that the stock market only provides us with information that's listed on the stock market. Hence, it is limited or it is narrow. You know, it gives us a skewed view of what the economy is all about. Okay, the stock market, it does not give us information about the cocoa seller. It does not give us information about the beautiful lady who's baking, okay, sitting somewhere in the corner of the street baking. It does not give us, the stock market does not give us that sort of information, okay? It just focuses on what is on its market, whereas the economy goes beyond that. So that will not be included in if you look at the calculation of the measurement of the stock market, it would not take into consideration a lot of things, activities in the economy. In a given economy, its output, okay, its output, that is the people it employs, the taxes they pay, all that will feed into the measurement, into the calculation, into the wider economy. And of course, the cocoa seller, the baker, of course, they are important too. So it's important for us to have a better view or measurement of the economy. Reason why I say that the scope of the stock market is narrow, it's skewed, it gives us a skewed view of what the economy is all about. It's limited, but what you call economy is broad, and that is it. So stocks have for the stock market, stocks have sort of indirect impact on the economy, okay, and individuals as well, not just the economy. I mean, yeah, there are individuals in the economy, so there's an impact on the economy and the individual. That's why many people still consider it when trying to gauge how the economy is doing, okay? So imagine a company is trying to issue shares, okay, to raise capital to fund a project, a growth project, and there's a stock market crash. Okay, the reason why the stock, this is if you listen and pay attention, this is the main reason why the stock market will impact the economy in a way, indirectly. Okay, is that so a company is you find a company in an economy, they want to raise funds, they want to raise capital for a project, and there's a stock market crash. What do you think will happen? Prices will go down. Suddenly, the company cannot raise the money to fund the growth, the project, okay? And as a result, it will likely cancel the project, because if they cannot raise the capital or the fund in the economy or from the stock market, sorry, they cannot go ahead with their company. And there are instances where they will even lay off workers. And in the worst of circumstances, they will shut down its operations. And clearly, you can make a claim that this is why the stock market impacts the economy. Again, like I said earlier, the market also affects individuals, not just the economy, individuals, okay? In a sense that, so a crash in the stock market will also hurt investors' portfolio. I have invested in the stock market, you have invested in the stock market, there's a crash. God, it's going to kill you. I mean, your portfolio is just going to sink like that. So once that happens, you consume less. You'll not be able to consume because your money is gone down. You can't consume. Okay, the value of your portfolio is gone down. In the long run, it's going to affect the economy, because once you can't consume, okay, if we had an economy that nobody's buying anything, nobody even has the money to buy anything, the producers that are going to produce, who are they going to sell it to? Back to what we said before in the economy. You produce, you hand it over to consumers, they pay you money. And if you're going to produce and nobody's going to buy and hand over money to you, the seller, because he can't hand over money, can't buy, because the stock market, if all things being equal, if your money is invested in the market and you do not have money because the market has crashed, the price has gone down, so you don't have money, how are you going to consume? And if you're not consuming, and if you're not consuming, it means that when producers produce, you can't buy, and you cannot buy those goods, then the producers or the sellers will also cannot go ahead and produce, because if the producer is going to buy, the economy will shut. And that's how it affects the economy. A case in point, 2018, 2019, when there was a financial, we had a cleanup where a lot of institutions went down. People had their monies in the Men's Gold and other institutions. I mean, it affected people's pockets. People could not consume. People, their monies had been locked up. They lost their monies and all that. They could not consume. So that is the kind of picture that I am trying to, paint for you to understand what I'm trying to say here. Okay, so the last point, which is time. Stock market and the economy, they focus on different periods of time. Okay, so the stock market and the economy, they're focusing on different periods. The stock market is a forward in terms of time, okay, or timing. The stock market is a forward-looking measure. Okay, take note, it's a forward-looking measure. The stock market is a forward-looking measure. Investors, you and I, we buy and sell stocks based on what we think will happen. Do you understand? So if you and I think that tomorrow, which is future, that's why it's a forward-looking measure. If you and I think that tomorrow, for some reason, of course, we cannot tell the future, but that is why it's about predictions, forecasting. Okay, so reason why you hear people say the stock market is for gambling and all that. I mean, I beg to differ anyway, but it's a forward-looking measure, okay, or market. Now, investors that you and I would want to buy, okay, based on what we think will happen in the future. In other words, the stock market will tend to rise if there's a strong belief among investors that tomorrow a particular company will be better than it was today. So if you and I think that MTN is going to be like, well, I mean, is MTN world class? I don't know, but if we think that MTN is going to do way, way, way better than today, it creates some sort of sentiment. We put our money in there and we are just waiting for that day to come where we will cash out, okay? And that makes it a forward-looking measure. The economy, on the other hand, tends to look backward. Why do I say so? Now, many will disagree with me here, but for me, I see the economy looking backward because some of the main indicators used to gauge the economy, okay, like if you want to gauge the economy, like unemployment, spending, inflation, these are usually reported with a leg. When I say a leg, what do I mean? When we decide today to look at the current levels of, let's say, unemployment, if we in the economy, we decide that what are the current levels of unemployment, we are actually looking at how many people were losing or gaining jobs last month up to date. So today is 29 January, okay? Let's assume it's the last day of the month, 31st January. If we want to know the current levels of unemployment, we are going to count or look at it from 1st January to date, and that's going back. And that's why I say it's, with that nature, I'm saying it's a backward timing. Whilst the stock market looks, ahead. All right, so these are just some few differences between the stock market and the economy. And I'll move to the next slide where I will leave you with a video. Please do pay attention. You would hear statements or claims that would summarize all that I've said. And you may also get to hear one or two new things I may probably haven't mentioned, but will be good for you to incorporate it into all that we've just said here. So let me just play this. Kindly do pay attention. It's just about, I think, 6 to 7 minutes video. So let's go.
As an investor, you will encounter days where the Dow is up 1,000 points.
We have the Dow intraday chart, the biggest points gain ever, 1,036.
You will also encounter days where the Dow is down 800 points.
The Dow Jones Industrial Average tumbled by 800. That's 3.2%. The Dow dropping more than 650 points, the largest December decline since the Great Depression.
People ask all the time when they see a huge move in the market, does this mean I'm going to lose my job? Does this mean I'm about to have the best year I've ever had in my business? What is the relationship between what stock prices are doing each day versus what's happening on Main Street, what's happening in the real economy? I like to use an analogy of a man walking a dog across a park. Try to picture that. You got a guy, he's got a leash, there's a dog on the other end of it, they're walking in the same direction. However, if you observe the way the man crosses the park, his gait, his stride, it's fairly straightforward, very few deviations, kind of like an economic trend. Then when you think about what the dog is doing, the dog is running around like a lunatic. The dog is barking at people. It darts to the left. It darts to the right. It strains on the leash. Maybe it chases a squirrel, barks again. The thing with the dog is that's the stock market. The man walking the dog is the economy. So they both end up in the same place. They're both sort of walking in the same direction most of the time. There's a lot less deviation in how the man walks than how the dog walks. And I think when you consider the stock market barking, jumping back and forth, straining at its leash, that's a really good way to control your own emotions and to say to yourself, okay, the economy is probably not fluctuating to the same extent that the dog is or the stock market is. So we use that analogy all the time. Here's the S&P 500 plotted against GDP growth. You'll notice that in any one given year, you can have some divergence between the two. Look at 2009, real GDP fell 2.5%. Stock market, meanwhile, went up 26% that year. The 1970s offer some examples of that. 1975, real GDP, meaning inflation-adjusted economic growth, fell 0.2%. Stock market was up almost 40% that year. Again, they're related, kind of going in the same direction over long stretches, but in any one calendar year, they don't necessarily have to look alike at all. Now, here's something really important. All things being equal, even if I gave you next year's economic information, what would you do with it? You certainly wouldn't know what the reaction of the stock market or the bond market are going to be. You can have any economic outcome and have any stock market reaction to it, up to and including a terrible reaction, a great reaction, or no reaction. Now, what about the reverse? Do stocks tell us what the economy is about to do? The answer is very unsatisfying sometimes. So stocks are thought of as a leading indicator for the economy, but a lot of times they get things wrong or stock market prices overreact.
Good evening. The stock market went into a free fall, losing more in one day than it did on Black Tuesday in 1929.
I always point out 1987, that was a 23% crash within one day. The economy didn't even notice.
I don't think anyone should panic because all the economic indicators are solid.
But we've had examples where the stock market has been an accurate predictor of what would happen with the economy. And maybe the best example would be the 2000 dot-com crash.
The worst day ever on Wall Street. All the major indices are now down for the year.
We had an incredible economy from 1982 until the year 2000. And then all of a sudden the stock market was saying things have gotten way too hot, started to come down, got worse, spread from technology stocks into mainstream stocks. And within a year, we were in a fairly long recession. So there are times where the market is giving you that signal. Then there are times where the market is giving you a signal that doesn't end up leading to anything. And being able to tell the difference between the two is nearly impossible, especially in real time. So whenever you hear someone make a stock market forecast based on how the economy is currently doing, or how they think the economy will be doing, it's very important for you to remember how many other variables impact stock prices and the stock market. Everything from geopolitics, natural disasters, interest rates, tax rates, whether or not there's any kind of fiscal program that takes place, whether or not there's any kind of change in the law for things like buybacks or dividends. There are so many things that can happen that are not GDP that will affect the prices of stocks that it's nearly impossible to point to any one metric, whether it's jobless claims or economic growth or overseas economic growth, and say this plus this equals that. If it were that simple, we would all be rich. Everyone would know exactly how to invest. And 2018 offers us a perfect example.
Exciting live breaking news. The American economy growing at its strongest pace in 4 years.
Payrolls rose by 250,000 jobs.
So here's a year where you've got solid GDP growth. You've got the unemployment rate steadily dropping month after month, millions of jobs being added, really no negative issues with the economy whatsoever. All of the ingredients that you can ask for to say, this is a good economy, this is a good environment for business. Stock market went down 5%. You say to yourself, well, wait a minute. You had told me at the end of 2017 that I would have all these great things. I wouldn't have expected a down 5% year for stocks. And that goes to show, how many other ingredients there are that affect the outcome. By the way, expectations are one of the most important ingredients. We came into 2018 already expecting all of that great news. So stocks have been priced for the best. We got the best, and guess what? They were already worried about 2019. The other thing I would mention, if you think about the dog analogy, walking through the park, a lot of stock market participants expect the Federal Reserve to watch the dog. And to some extent, the dog is worth watching. But I do think it's important to realize Jerome Powell, the Federal Reserve Chairman, his real job is to focus on the man walking the dog. And so you may see a lot of volatility in the markets that doesn't necessarily get a reaction from the people who set monetary policy.
Invest in you. Ready, set, grow. CNBC and Acorns.
All right. So that's a short video. Well, I don't know about you, but for me, one main thing I picked from the video is the man-dog analogy the guy used in describing the stock market. So he's describing the stock market with a dog and then the man. And for me, that sums it up, where he's saying for him, the man represents the economy and then the dog represents the stock market. So yes, this is the end of the presentation, and I believe there will definitely be a couple of questions. So I don't know if Kofi, you come in at this point, or they can just flow.
Francis, I think it is a very powerful presentation. You have raised the bar, and I think subsequent facilitators will have a tough time. And I hope you can hear me. Yeah,
Thank you.
You've done very well. You've done very well. Okay, so it's time for questions. All right, Francis, most of the questions have been put in the chat box. All right, the first question came from Lauren.
So I see, is it 16 questions I see?
Yeah,
Interesting.
Number. So first question came from Lawrence Kwame. I think during your presentation, you made mention of the word proxy. In simple terms, proxy is an English word, simple English word, but I don't know the context with which we're referring to it. So
I'm using it.
Just elaborate on that for him.
Okay. All right.
And,
so should I go ahead, or you want to add another question?
Yeah, let me just add the next question so that I just pick it up. So Yakubu, as I said, please, why is it that when the stock price of MTN, for instance, drops, it affects only the Composite Index, but in the case of EcoBank, it affects both indexes? I think that one too was in your presentation, so just need an elaboration on that one.
Okay.
The Kwame comes in again. I hope that question was clear.
Yeah, it was clear.
So Kwame Lawrence also comes again with, when can a company be qualified to be listed on the GSE?
When can what?
A company be qualified to be listed on the Ghana Stock Exchange? And it comes in again, can anybody at all buy shares on the GSE, and how is it done? I think that would be about it for the questions. You can still drop in your questions so that we attempt answering them. So Francis, kindly go ahead.
Okay, so first I got the proxy question. Now, yes, proxy is, yes, you said it's an English word. Of course, it's an English word. It's more like a representation, okay? So, if, let's say, you do remember when it comes to voting, okay, elections, some people are given the authority, or some people represent others, okay, and these are legal terms, okay. So in sort of voting, for instance, if you are not present, you the one that you are eligible to vote, okay, if you are not present, there's someone representing you to do that voting for you, right? Okay, so that's a representation. In the same vein, when you look at the stock market or the economy, what we are saying is that the GDP figures is representing the economy. The, what do you call it? The Composite Index or the Financial Stock Index is representing the stock market. I don't know if that answers the question.
Yeah, Lawrence, Kwame Lawrence.
The one who asked the question.
Yes.
So it's more or less a representation. I mean, if you're doing a research analysis.
Yes, please.
Yeah, if you're doing a research analysis and all that, you're doing your regression analysis, and you would need proxies. You would need certain data to represent something. Do you understand? So you're talking about the stock market, you're talking about the economy. You need something to represent. You need data. You need those numbers to represent what you are trying to explain or research on or describe. Do you get it, Lawrence?
Yes, please. Yeah, later I Googled it myself and I saw something like a broad representation of the raw market.
Precisely. Okay, so the next question that I think was, if I got it right, why MTN affects the composite index and does not affect the FSI, and why let's say a banking stock like EcoBank affects FSI but does not affect the CI. Is that a question?
Yes, exactly.
Okay, so like I said, we have two indices in Ghana on our market. We have the general market, so the general comprises of all the companies listed, all of it, it doesn't take out even one, all of it. And that is measured through the composite index. So if it's representing all, it means that EcoBank and any other bank or like insurance company or any other financial institution is part of it, right? But if you take MTN is not part of the financial stock index. MTN is not a financial institution. Well, unless of course in the future, which I've heard, if they decide to just to separate their Momo business from the MTN itself, then it means that they will probably want, if they want to list MTN Momo alone, because the Momo is a financial business. So if they want to list the Momo, then they will list it on the financials. Then they will list it on the market, but in terms of measuring it, it will be captured in the financial stock index. And again, it will also be captured in the composite index, because again, the composite index comprises of everything. It's an entire market thing. So yes, if MTN today goes up or down, it will affect the entire market. But when you are reporting on the financial stock index, it won't affect it because it is not a financial institution. So when you see the reporting of EcoBank, the reporting in terms of the index, if EcoBank goes up, it will affect the entire market, yes. But if you are reporting the FSI alone, you would take that EcoBank price, whether it's gone up or down, and report that as well. I think it makes sense.
Yes, sir. Thank you.
And when, if I got it right, when does a company qualify to be listed on the stock exchange? Is that a question?
Yes, it's when.
So yes, there are quite a number of what do you call it, points to look at if you want to list on the stock market. Now, the stock market has, sorry, I probably didn't mention this. I don't know if most of you know. The stock market has a market called the GAX. It's Ghana Alternative Market. Okay, that's a market where you can list, let's say, smaller companies. So you don't need to be big. You don't need to be a company as big as MTN, or as big as GCB Bank, or as big as EcoBank before you can list on the stock market. You can have you can start your business today. You have to set up your small company, and before you know it, if you want to raise capital, as long as you will go through the necessary steps, you can't just get up and go onto the stock market. You first of all will need to identify, you have to have your books in check. And when I say your books, you have your financial reporting intact, corporate governance should be intact. I mean, have your house in order. It's like inviting somebody of high repute into your home. I mean, you want to have everything intact, you know, have your house in order. Once you do that, identify or speak to an investment banker or an investment bank. Over here, you speak to licensed dealing members of the Ghana Stock Exchange, okay, LDMs. And they, once you have your books in check, and they would also look at your books, see to it that it's actually in check, and then they will put together what we call a prospectus, okay? So the prospectus details everything about you, the company. It's like introducing yourself to somebody. You tell the person everything about yourself. So the investment bank will help you put together that prospectus, okay? So the prospectus will detail every single thing, where you are located, when you came in, the business came into existence, the directors of the company, how much you've made over the years, how much you intend to make in the future, what your forecasting is like, even how much directors are earning as salary, bonuses. In fact, the prospectus details every single thing. You can't leave one thing out. And once the investment bank or the LDM helps you put this document intact. You are being introduced, okay, to it's sent to the Securities and Exchange Commission. You've heard of SEC. They also go through, and once that is done, you also advise or send one to the stock exchange pending approval, okay. And then once that is done and everything, and Ghana Stock Exchange SEC and everything, they are satisfied, you're good. You set a deal. Say that again. You set a day to outdoor the company being listed on the market, and then you take it from there. I mean, there's a main market and then there's a alternative market. So you look at the size of your company, you look at where you feel where you know that you would fit. That's why there's an alternative market. The alternative market is for small companies, and then the main market is for the the bigger guys. The next question, can anyone at all buy shares? Is that what the question was about?
Yes.
Okay, so yes, of course, anybody. I mean, yes. Unless of course, when, let me take you to the IPO time. Unless of course, when a company is coming to the market for the very first time, yes, even that one, any local person can buy, anybody can buy, but there is a percentage for, I think, outsiders, foreigners. Okay, I think I'm right. There's a percentage for foreigners, but aside that, anybody. I mean, let's limit it to this country. If you're in Ghana and there's a company here that wants to, any Ghanaian can buy. Anybody can buy. Anybody can buy. So that's it.
Please, assuming I want to buy some right now, can I just walk to the GSE and see I'm coming to buy, or I have to pass through some coins?
Okay, so you don't go to the GSE, the Ghana Stock Exchange, to buy shares. You go to a broker. Okay, so you walk into a brokerage firm, and yeah, you speak to a broker. But
I read something recently. They have two types. Either you pass through a broker or dealer, or through an auction. Okay, so is it always that you have to pass through a broker, or use the auction method by going straight to the GSE?
So when you read, what did they say the auction was?
The auction is the seller dealing directly with the buyer, and the dealer means passing through a broker, like a middleman.
Okay, so yes,
that is what I expected. So
that's fine. So yes, you meet the broker. Now there are certain I think, well, they're quite a number though. There are certain you won't find on the stock market right now. They are not listed. Okay, like Vivo. Okay, Vivo. I think that's Shell. Like British American Tobacco, BAT. Okay, like CFAO, right? Now these are OTC, over the counter. So because they are not on the stock market, in practical sense, it's more like dealing with a person directly. Do you understand? Recently, Mechanical Lloyd also went off the stock market. They took the stock out of the board. Okay, that is the the stock exchange. So, like Vivo and others, you need a one-on-one, more or less. Okay, because if you want to buy MTN, when you go through the broker, and it's done through the platform that we have a trading platform. I don't know if I can show you, but okay, so this is the trading platform. I'm sure you can see my screen. Can you see my screen?
Yes, Francis, we can see it.
Yes. So this is the trading platform. Now you can see the companies that are listed here. You can see BOPP, you can see Cowbank, you can see EcoBank. I mean, these are the symbols. You can see Stanchart. So these companies that are listed, this is how the board looks like. This is how the stock market exchange platform looks like. So we are buying and selling. You don't know if I'm buying for you, I don't know who is selling to me. I mean, it's an electronic system. So I put what I see. Let me try and explain something to you. Can you see the BOPP? Can you see Cowbank? No, can you see Cowbank? You can see Cowbank, CAL, Cow. Now, on the right side, it tells you how many is on offer. You can see 10,000, 10,000, and that 10,000 is the number of shares that's on offer. And the left side, which is blue, you can see that there's 10,000 also bid, and that's to buy. The 10,000, it's the same, but it is not matching. When I say it's not matching, the transaction is not happening because there's, for the right side, there's 85 pesos, and on the left side, there's 82. For any transaction to happen, the buyer must tally. Okay? So for this transaction to take place, you as a buyer cannot, you as an investor, you can't walk to stock exchange to say you want to buy. You can't come here. This platform that you are seeing, I am a licensed dealing member. I am an authorized dealing officer, licensed by the stock exchange. So I have the license to be on this platform. So before you can get it, you need to come through me. Okay? Now, the other one that you are talking about, which is like the Vivo and others, you have to sort of deal with the person directly, which is the Vivos and the others, the British and American Tobacco, the CFU. You know, you can't really get it on what I just showed you, the platform that I just showed you. So it's more or less like a face-to-face. Whereas this one that I just showed you, I don't know who is selling to me. The sell side, the volumes are there, but I don't know who exactly. I don't know if it is you, Lawrence, selling it. You don't know if it is me, Francis, buying it. The transaction once is on the board and the prices agree, it matches, and we're good to go. We move. You understand?
Okay. Thanks for answering the question. And we have a last question to answer. Then we can end the session. All right.
Kofi, I have a question. It's a bit lengthy, so I couldn't type it.
Oh, okay. Who am I speaking to, please?
Maxwell.
Maxwell. And we are almost doing 2 hours.
Maybe since we have a platform, I think you have a page. Maybe some of the questions can be put on that page, and then we'll take it from there. So maybe we can do 1 or 2 questions, and then we'll wrap up.
All right. So Maxwell, please let me read the last question. I think that would be quite short and straightforward. So Fela would like to know the typical day in your life as a trader at work. So how is your day? How does it go? Then Maxwell, when he's done answering this, he come in. Okay.
All right.
Yeah. So a typical day. Well, probably run through most traders, but for me, I wake up quite early. 5 a.m. I'm up. If it's early for you, well, it's early for me though. So 5 a.m. I'm up. About 6:30, 6:15, I'm in the office. Sometimes even earlier. So we do get because our business is more of buying and selling, okay, we do get trades coming a lot, okay? So you have orders coming in from individuals, you have orders coming in from institutions as well. Fund managers bringing in orders. So you need to come in early, put your orders in order, okay, which we call flows, okay? So you need to put your flows together, and before the market opens. Now the market opens for trading 10 a.m. but 9:30 we have what we call the pre-opening. So you can go into the market, what I just showed you. You can go in at 9:30, and before you do that, as a broker, as a trader, you should have your orders in your order book, we call it, and you should speak, because if a fund manager gives me an order to buy 2 million MTN shares and I don't have it, I need to speak to other traders. I need to speak to other finance houses to see how I can get the order, because if for some fund managers or for some investors or clients, they are impatient. If they give you an order and for like a week or two, you can't execute, they take it to the next person and all that. So you need to be quick and be interacting on a daily basis between 7 to 9:30 to whilst you're getting your orders intact, speak to traders and see where you can get your orders, okay, and show your flow. So you get a trader call. I call some, I'm like, okay, what's up for today? What are your flows? We said, oh, okay, today I'm selling 1 million MTN, I'm buying 1 million GCB. Okay, then I also say, okay, no, I'm not buying GCB, I'm not buying MTN, I'm buying GCB, you know. So you sort of like talk to each other and fill the person up and size up and see what the person is buying and selling. If you have it, then you sort of talk, and also that's like trying to you know, do that before the market. And then when there's a pre-opening, before the market opens, you can put your orders on the board, but it will not match. Okay, it's like warming up to play a football game. So 10 o'clock market is open. You and even again before, just to chip in, before you put your orders on the board, aside speaking to colleagues in the industry to know what the flows and other stuff going on, you also would have to speak to one or two clients, speak to your clients, because sometimes you want to be sure about setting orders. Is the order firm? When a client gives you an order, yes, an order is an order. Once it's signed, once the order is signed, it is legit. But sometimes there are certain orders that are sort of not firm. The firm meaning that the person has sort of shown an interest to buy, but the person has not really firmed up that order. So, if you get, for example, if I get, an investor tells you, if I get 2 million MTN shares, I'll buy it tomorrow. The next day, you go on and you like, oh, you speak to other colleagues, do you have MTN to sell? I want to buy MTN. Once you do that, you get that order. You can't just go ahead and go and buy for the client. You need to get a precise instruction and order and to firm it up. So you do all these things, you know, prior to market opening. Market opens, trade goes on. Now the market is open from 10 a.m. and closes at 3 p.m. All right. Once that is done, you need to see, once market closes, you need to see that those orders that you've executed, they are allocated to the respective investors. Okay, you need to do that within the time. I mean, it can be hectic, but you need to ensure that you allocate it to each and every investor's portfolio, right? And then see to it that there's enough funds, I mean money in the account, the bank account that is going to fund the trades that you've done. So if you've bought shares, you should know that you are going to pay for those shares. If you've sold shares, you should know that you are going to receive funds. You get it. And also day in, day out, stock exchange and other financial institutions do release, registrars and all do release statements and press releases that you would have to factor into what you're doing. So it's important that you read these articles and press releases and all that, just so that you can incorporate it into your line of work. So yeah, basically that's it.
Okay, so thank you, Francis. So Fela says he loves this. All right, Fela, thanks for the comment. All right, so Maxwell, can you come in?
Yes, Francis, I've enjoyed your presentation. You've tried not to incorporate too many jargons. So for people like us who find ourselves just, venturing into the space of stock and whatnot, it's been a rather refreshing, take on matters. But my point, my particular area of interest was when you try to sort of water down how we view the economy and the stock market, where you say the stock market is like forward-looking in terms of how it attracts investors, and the economy is the reverse. Although you said that people might disagree with you, that means you admit that it's a controversial standpoint. I'd just like to, let you know how I was able to appreciate the point and how maybe I find that certain aspects of that statement might be a bit conflicting. That way you can be able to explain it or probably better elaborate on it. And here's why. So for the stock, you said people bet on, let's say, capital gains in the future. So people pour in money with the hope that in the next couple of years, the stock price will go up and they would make, let's say, a profit on it. That's fine. But at the same time, what informs those decisions is, let's say, info from, let's say, the past, or the past or in the immediate past, so to speak. So like earnings reports and let's say how the company's balance sheets are looking. So I feel like that's a component. Obviously, it's sort of speaking to the fundamentals. And if you think about it, the fundamentals can only be spoken to based on what has happened and not what is projected to happen. Maybe the current standing of the company and how it's better poised to, let's say, rally in a certain direction based on what they have done. At the same time, it's also possible for a stock to be projected to go up based on what they would do. Like when, let's say, Tesla makes an announcement that they are going to invest heavily in semiconductors or new battery technology. That's something they haven't done yet. They announced that they're going to build, let's say, a mega factory in China and, let's say, Russia and all those. These are things that are future plans, but they feed into the speculation of a stock. So I think it's a two-way thing in terms of how I understand what attracts investors into, let's say, a share value projection or a stock. And also from the economic angle, where you wanted to paint a picture where typically we look backwards. That's actually very true. But at the same time, I feel that even, let's say, budget readings and government announcements, case in point, like, let's say the e-levy, which talks about government's forward plan to tax electronic transactions, might affect investor sentiment. You understand? And also, let's say Biden's 1.2 trillion infrastructure bill would also determine what sentiment is about the economy. So I know you admitted in your statement that it's an overly simplified take to have that the economy looks back and the stock market looks forward, but try and shed more light on how you meant it, because I've been struggling to understand, the point we're trying to make in that regard.
Okay, that's good. I do appreciate all that you've said, and I think you're right on most of them. But again, if in the beginning, like you said, I did say that it's debatable. Yes, but you and I know that economists do never agree on the same thing, okay? And you would have to back them up with facts, or you would have to back them up with whatever analysis that you can do. So yourself, you made some, when you were talking about the stock market measurement and all that, you made some forward-looking statements like the Tesla example that you gave. So for me, my understanding is you are looking into the future, right? As an investor, investing on the stock market. Now, again, this as a layman or as a layperson buying stocks on the stock market, what I was trying to say was that once you are committing funds to the stock market, in your mind, forget about the analysts and the researchers who do their research and all that. All I'm saying is that as an investor, as a layperson, or as whatever, who decides to commit funds or put funds into the market, your intention is you're looking forward, hoping that this particular stock, because if you know, and you can know for a fact, of course, but if there's something that triggers you for you to think that a company is going to do, the price of the stock is going to go down, I don't think you put your money in it. But a lay person is putting his or a money company with the forward-looking mindset, okay, of that company or the price of the company. And so that's what I meant by the timing, okay? Not paying so much attention to the technicalities of it, where you have analysts and research, just like you said. I totally agree. That's why I put in the caveat in there that, yes, of course, this is a bit, I know it's controversial. I mean, we could go back and forth on it, but I think it is what it is. So I agree with what you said, totally agree. And I think you would also see some sense in what I'm saying and where I'm coming from in terms of looking at the forward looking and the backward. I mean, with the economy, for example, made an example of, I talked of looking at the current levels of unemployment, where you would want to, what has been jobs that have been created up to the time that you are looking at it, okay? The reason why I try to make that sort of forward and backward looking, comparison. So I also agree with what you've said, but I think it's also, if I can say it quite clear what I'm saying. Yeah, Maxwell.
Okay, Francis, I think I'm satisfied. Thank you so much.
All right, thank you.
Hello, Francis. Thank you so much for this session. I think it's been very, very good. We